Hi there, I'm Clay Gardner, co-founder, co-CEO, and chief investment officer at Titan. I'm pleased to be here with Paul Ferraro, the global head of private wealth from Carlyle. We're thrilled to have Carlyle as a partner on the platform. Paul, great to have you here.
Yeah, thanks, Clay. It's great to be here, and it's great to partner with Titan.
Paul, how would you describe what you do to a close friend that doesn't have a great understanding of financial markets?
So banks in the U.S. used to lend money to mid-sized companies, but because of regulation and consolidation within the industry, they're no longer interested in doing that. If you're a large company, sure, a bank will lend you money, but they're going to syndicate that loan to hundreds of investors. So as we say in the industry, the banks are in the moving business today. They're not in the storage business anymore. And when you're a mid-sized company, your loan's just not big enough to syndicate. So that loan has to be held. It's essentially illiquid. And so firms like Carlyle and our peers, we had to step into that breach because there was no capital for mid-sized companies, many of which were at this inflection point in their life cycle where they need capital to grow. And that's a really important piece of the U.S. economy. So in simplistic terms, we're lending money to companies who cannot get capital from banks.
Can you give us a 30-second overview of Carlyle and its role in the capital markets?
Yeah, sure. So Carlyle was founded back in 1987. So we've been at this about 35 years. Today we manage over $350 billion of alternative assets. We do that in really three main businesses. The first being private equity. In private equity, we buy companies, and during our 3 to 5 year hold period, we're looking to create value through a few ways. Number one, increasing top line revenue. That can mean new products. It can mean new markets. It can mean better management. We're also looking to create value through maximization of cash flows. That allows us to pay down debt and create value that way. And then the third one is operational improvements. This helps us to increase the margins of that company. And then the idea is after our hold period to sell that company at something more than what we paid for it. We've talked a lot about global credit today. And in credit, what we're doing, as I mentioned earlier, is we're lending to companies that banks, for whatever reason, really have no interest in lending to today. And then finally, global investment solutions. This is a business where we're offering primary investments, secondary investments, and co-investments in private equity to our clients.
So how has private credit traditionally been used for institutions like endowments and pension funds?
Yeah, so private credit over time has proven to have certain benefits over traditional fixed income. And what I would say is, number one would be better protections. So our ability to get covenants from borrowers protects us from bad outcomes. Number two, because these loans are illiquid, we're doing a lot more diligence up front, and therefore we know these companies better when we lend to them than maybe a traditional money manager might. What that leads to is lower default rates, right? And then because these loans are illiquid, there's what we call an illiquidity premium. So we expect higher returns from private credit than we do traditional fixed income. And then finally, most instruments, credit instruments within private credit are floating rate. So when we get into a rising rate environment like we're in today, we tend to participate in those higher rates. So because of all those reasons, institutions have used private credit as a risk mitigator and a return enhancer. So they're using it to replace traditional fixed income.
How should individual investors conceptualize private credit in their broader portfolio?
So private credit is less liquid than traditional fixed income. So all investors have to really look at their portfolio and determine how much liquidity they need, number one. And said differently, how much illiquidity can they withstand? Our view is if you're a long-term investor, you should have an allocation, some portion of your portfolio in alternative investments, and that would include private credit. And the thinking behind that is, as we talked about, because of this illiquidity premium, you should get higher returns from it. And from all the metrics I mentioned earlier, you could do that at lower risk.
How might the Carlyle Private Credit Fund perform in today's market environment? How is it relevant today? Is it more or less so relevant in your opinion?
Yeah, sure. So our primary goal is to generate current income for shareholders throughout a market cycle. And that doesn't change no matter what environment we're in, right? So if we're in a low interest rate environment, which we've been in for a very long time, we're still going to generate income that should be greater than what you can get in traditional fixed income. It might be at the low end of our range, but it still should be better than traditional fixed income. In a rising rate environment, which we've entered, we will participate on the upside because our benchmark rates, rates like LIBOR or SOFR, right? They're going up, and therefore the coupon payments we're getting from our borrowers are also going up, and therefore we pass that on to clients.
How has Carlyle been navigating the current market environment? What sorts of changes has Carlyle made in a rising rate inflationary environment?
The benefit of investing with Carlyle Global Credit is you get the strength of our underwriting capabilities, you get the breadth of our global platform, no matter where we are in the market cycle, right? And so when we're in a period of inflation like we're in today, we're looking for high quality businesses that have the ability to pass on any cost increases to their end clients as well, right? And so that's been a key for us as far as credit selection goes. As far as interest rates, we're always looking to our borrowers for, number one, how much liquidity they have. What is their ability to meet these higher rates, right? And pay down the debt that they've accumulated. Mm-hmm. And then from a leverage standpoint, that's something that we've been very focused on. You can call us smart or lucky, but as we entered 2022, we saw volatility in the market. We took leverage levels on the fund down significantly. And it wasn't until really we got into the second half of 2022 that we started adding leverage back. And we've benefited from that. And you can see that in the way we've been able to create value so far this year.
What advice would you give to a younger investor or someone who's relatively new to investing?
Yeah, I mean, the first thing I'd say is timing the market is hard for even the best investors in the world, right? You can see that in their own performance. Mm-hmm. So, my suggestion is be systematic, right? If you can dollar cost average and buy more shares of something when prices are low and buy less shares of it when prices are high, you end up doing pretty well over time, right? My second piece of advice would be include, where possible, non-correlated assets to the portfolio, because you don't want everything moving in the same direction at the same time, especially when we're in turbulent markets like you could say we're in today.
Paul, we're hearing a lot about the democratization of alternative investing, taking products and investment funds historically inaccessible by retail and making them accessible. I'm curious to hear your perspective and Carlyle's perspective on this trend and what role you may want to play in this trend.
Yeah, so one of our founders, David Rubenstein, has been focused on this for a long time. And it's a huge trend with Carlyle and our peers. And I think what you should expect to see is more offerings coming out of firms like Carlyle with lower suitability, so we can actually make sure people who don't maybe meet some of these accreditation levels can get access to products that we think could potentially generate higher returns with lower risk. And so that's why we're here, and that's why we're excited about this partnership with Titan.
Paul, thanks for having us.
Thank you, Clay. Appreciate it.